Nobody likes paying income tax, but very few people know where it actually came from. For most of American history, the federal government didn't tax individual income at all. Instead, it relied on tariffs and excise taxes, taxes on goods like whiskey or imported products, to fund its operations. But everything changed during the Civil War. The federal government needed a new source of revenue to finance the Union Army, and in 1861, Congress passed the first federal income tax in American history under the Revenue Act of 1861. This tax imposed a flat 3% rate on incomes over $800, equivalent to about $28,000 today. A year later, Congress revised the tax structure, introducing the Revenue Act of 1862, which created a progressive tax system where higher earners paid a higher rate. This law also established the Office of the Commissioner of Internal Revenue, the early version of what would later become the IRS. Unlike today, tax collection was manual and enforcement was difficult. The federal government employed assessors to determine each person's income, which meant tax records were often based on self-reporting, leading to fraud and evasion. Despite these challenges, the tax successfully raised hundreds of millions of dollars to fund the war. At the time, the income tax was seen as a temporary wartime measure, and true to that promise, Congress repealed it in 1872. But during its brief existence, it had set a precedent, one that would return in a few decades. For the next 2 decades, the federal government relied on tariffs as its primary source of revenue. But by the late 19th century, the economic landscape was changing. The Industrial Revolution had created vast fortunes for some, while many ordinary Americans struggled under an economy that favored the wealthy elite. Populist and progressive movements pushed for tax reform, arguing that tariffs placed an unfair burden on the working class, while the richest Americans contributed little to government revenue. In 1894, Congress responded by passing the Wilson-Gorman Tariff Act, which included a 2% income tax on those earning over $4,000, about $140,000 today. The tax was designed to target the wealthiest Americans and make the system more equitable. But almost immediately, opposition groups formed, arguing that the new tax was unconstitutional. One of the biggest challengers was Charles Pollock, a wealthy shareholder in Farmers Loan and Trust Co., who filed a lawsuit arguing that the income tax was a direct tax and therefore had to be apportioned among the states according to population. The case, Pollock v. Farmers Loan and Trust Co. in 1895, made its way to the Supreme Court, where the justices ruled that the income tax violated the Constitution. This decision struck down the tax and effectively shut down any future attempt at a federal income tax, at least for the time being. The Pollock ruling fueled even greater demand for reform. Many saw the decision as favoring the rich, protecting their wealth while forcing ordinary Americans to bear the brunt of federal taxation through tariffs. The progressive movement, which was growing in political influence, argued that the government needed the ability to tax income directly. In 1909, President William Howard Taft and Congress proposed the 16th Amendment, which gave the federal government the explicit authority to levy an income tax without apportionment among the states. At first, opposition was fierce. Many believed a direct income tax gave the government too much power over personal wealth. But economic pressures and public sentiment pushed the amendment forward, and it was ratified in 1913. Almost immediately, Congress passed the Revenue Act of 1913, reintroducing the income tax. The law set a progressive tax structure with rates ranging from 1% for lower income earners to 7% for the wealthiest. Initially, this tax affected only a small percentage of Americans, primarily the rich. But just as before, global events would soon change that. In 1914, World War I broke out in Europe, and by 1917, the United States had joined the fight. War is expensive, and the government needed money fast. Congress responded with the Revenue Act of 1916, which drastically increased income tax rates and expanded who had to pay. The top tax rate jumped from 7% to 77%, making it one of the highest in U.S. history. For the first time, the federal government started using tax withholding, requiring businesses to deduct taxes directly from employees' wages. This made it easier for the government to collect revenue without relying on individuals to file and pay at the end of the year. By the war's end, income tax had become the largest source of government funding. Even after the war, the federal government continued relying on income tax. The 1920s saw tax cuts, particularly under Treasury Secretary Andrew Mellon, but the system remained in place. Meanwhile, legal challenges sought to define what exactly counted as income. One of the most significant cases was Brushaber v. Union Pacific Railroad in 1916, where the Supreme Court upheld the 16th Amendment, confirming that Congress had full authority to impose income tax. In Eisner v. Macomber in 1920, the court ruled that stock dividends were not taxable, setting an important precedent on the definition of taxable income. These rulings shaped future tax law and influenced how income was reported. During the Great Depression, tax policy changed dramatically. President Franklin D. Roosevelt raised taxes on the wealthy to fund the New Deal, which provided economic relief programs, but once again, war would change the game. When the U.S. entered World War II, the need for revenue skyrocketed. The Revenue Act of 1942 transformed the income tax system into what we know today. Before the war, income tax had only applied to a small percentage of Americans, but by 1945, it covered nearly everyone. To ensure consistent revenue, the government introduced mandatory payroll withholding, where employers deducted taxes before wages were paid. This system remains in place today. By the end of the war, income tax had become the primary source of federal funding, a position it has held ever since. In the 1950s and 1960s, income tax rates remained high, with the top bracket exceeding 90%. While most Americans paid lower rates, frustration with the system grew. By the 1970s, inflation and economic stagnation led to calls for tax reform. In 1986, President Ronald Reagan signed the Tax Reform Act, which simplified the tax code, lowered rates, and eliminated many deductions. This reform marked a shift toward a system that aimed to broaden the tax base while reducing individual rates. Despite these changes, debates over income tax have never went away. In the late 20th century, some groups have been advocating for the elimination of income tax altogether, proposing alternatives like the fair tax, which would replace income tax with a national sales tax. Others pushed for a flat tax where everyone pays the same percentage regardless of income. Today, income tax remains the largest source of federal revenue, funding everything from the military to social programs. But debates over tax fairness, rates, and loopholes continue. Some argue that lowering taxes boosts economic growth, while others believe the wealthy should pay more to reduce income inequality. The rise of tax havens, corporate loopholes, and digital transactions have added new layers to the debate. But one thing is certain, the income tax isn't going away anytime soon. From its Civil War origins to its transformation into a mass taxation system, it has become a cornerstone of the U.S. government. So, is the modern income tax system the best way to fund the government, or is it time for a change? Let us know what you think in the comments.